Scene script. Ever wonder how a small sum of money can turn into a fortune over time? The secret lies in compound interest. So what exactly is compound interest? Picture this. You're planting a seed in the fertile soil of finance. This seed is your initial investment or principal. Now, with simple interest, you're just watering that seed with a fixed amount of water each day. The seed grows into a plant, sure, but the growth is linear and predictable. Compound interest, on the other hand, is like adding a potent fertilizer to the mix. Not only does your seed, the principal, grow, but the growth itself grows. It's interest on interest, a powerful cycle that accelerates the growth of your money tree. You're not just earning interest on the initial amount you put in, but also on the interest that you've already earned. It's a snowball effect. The more it rolls, the bigger it gets. Let's paint a clearer picture. Say you invest $1,000 at a 10% annual interest rate. With simple interest, after 10 years, you'd have $1,500. Your original $1,000 plus $500 in interest. But with compound interest, you'd have nearly $2,600. That's over $1,000 more. This is because each year the interest is calculated based on your increased total, not just your initial investment. Why is it important? Well, it's a cornerstone of personal finance and the key to building wealth over time. It's why your savings account grows, why your retirement fund swells, and why investors are so keen on reinvesting their dividends. Compound interest is the silent, tireless worker bee of the financial world, quietly making honey in your accounts. However, it's not just the concept, but the application that matters. The magic really starts to happen when you let compound interest do its work over long periods of time. The longer you leave your money invested, the more dramatic the compounding effect becomes. So, compound interest isn't just about growing your money, it's about growing your money at an ever-increasing rate. Now, you might be thinking, how does this magical compound interest actually work? Well, let's break it down. The formula for compound interest is actually quite simple. It consists of three main components: the principal, the interest rate, and time. The principal is the initial amount of money you invest or loan out. The interest rate is the percentage of the principal that is added to it over a certain period of time. And time, well, it's just the duration for which the money is invested or borrowed. Let's imagine you're planting an apple tree. The principal is the seed you plant. The interest rate can be thought of as the rate at which the tree grows apples. And time, that's the number of seasons you let the tree grow and produce more apples. Now here's where the magic happens. As the tree grows, it doesn't just produce apples from the initial seed, but also from the new branches that have grown because of the initial seed. This is the essence of compounding. You earn interest not just on your original investment, the seed, but also on the interest that has been added to it, the apples from the new branches. The more time you give your apple tree to grow, the more apples it will produce. The same goes for your investment. The longer you leave your money invested, the more it will grow due to the magic of compounding. Consider this: if you invest $1,000 at an annual interest rate of 5%, after 1 year, you'll have $1,050. But if you leave that money invested for another year, you'll earn interest not just on the original $1,000, but also on the $50 of interest you've earned. So at the end of the second year, you'll have $1,102.50. And this growth accelerates over time. Remember, the magic of compounding isn't just about the amount you invest, it's about the time you give your investment to grow. So what does compound interest mean for you and your financial future? Well, in the grand scheme of things, compound interest can be a monumental game changer. It's like a snowball rolling down a hill, constantly growing as it picks up more snow along the way. In the same sense, your money grows as it earns interest, and then that interest earns interest, and so on. This is the long-term impact of compound interest on your savings and investments. Now let's paint a picture. Imagine you have a seed, and you plant this seed in the fertile soil of an investment account. You water it regularly by making consistent contributions. Over time, this seed sprouts and grows into a tree. But here's the magic part. The tree grows more trees, each producing their own seeds, which in turn grow more trees. This is the essence of compound interest. It's your money making more money, which then makes even more money. The key to this process, however, is time. The longer your money has to grow, the more powerful the compounding effect becomes. That's why starting early and investing regularly are so crucial. Even small contributions can amount to significant sums over long periods. It's not about having a lot of money to start with. It's about giving your money the time it needs to grow. Compound interest can be instrumental in achieving your financial goals, whether that's buying a house, funding your child's education, or building a comfortable nest egg for retirement. It's not just about saving money, it's about making your money work for you. But don't be fooled into thinking this is a get-rich-quick scheme. Compound interest is a long-term strategy. It's about patience and consistency. It's about understanding that wealth is not built overnight, but rather over decades. Compound interest can be your best friend when it comes to growing your wealth, but remember, it's a slow and steady race, not a sprint. But wait, is there a dark side to compound interest? Indeed, while compound interest can be your best friend when it comes to investments, it can also be your worst enemy when it comes to debts and loans. The same principles that make your money grow can also cause your debts to balloon if not managed properly. Let's imagine a scenario. You've taken out a loan, perhaps for a car or a house. The interest on that loan compounds just like it does on your investments. But in this case, you're not the one reaping the benefits. The longer you take to pay off your loan, the more interest accrues and the more your debt grows. This is compound interest working against you. Just like how compound interest can turn a small investment into a fortune over time, it can also turn a manageable debt into a financial nightmare. Every day, week, month or year that you delay in paying off your debt, you're allowing interest to compound on top of interest. This is why it's so crucial to understand the terms of your loans and to pay them off as quickly as possible. Now consider credit card debt. It's notorious for its high interest rates. If you only pay the minimum amount each month, you're barely scratching the surface of your debt. Most of your payment is going towards the interest, not the principal. The remaining balance continues to accrue interest, and over time you could end up paying several times the original amount. This, my friends, is the dark side of compound interest. It's a force that can rapidly multiply your debt, leaving you in a deep financial hole. It's a trap that's easy to fall into, especially if you're not mindful of your spending and borrowing habits. So, while compound interest can be a powerful tool for wealth creation, it can also be a dangerous weapon when used against you. Let's remember to use this tool wisely to create wealth, not debt. So, how can you make compound interest work for you? Let's dive right in. First off, the most effective way to harness the power of compound interest is by saving regularly. This doesn't necessarily mean stashing away huge sums of money. Rather, consistent, manageable amounts saved over time can lead to significant growth. Think of it as a snowball effect. The more you save, the bigger your snowball gets, and the faster it grows as it rolls down the hill. Next, consider reinvesting your dividends. When you receive dividends from your investments, you might be tempted to spend them, but resist that urge. Instead, reinvest those dividends. This allows your investment to grow exponentially, as you're effectively earning interest on your interest. Again, it's the power of compounding at work, magnifying your financial growth over time. Beware the dark side of compound interest, though. High interest debt can undo all your hard work in a flash. If you're carrying any such debt, prioritize paying it off. The interest you're paying on that debt could be going into your savings instead, working for you rather than against you. Patience, my friends, is a virtue, especially when it comes to compound interest. The true magic of compounding reveals itself over time. It's not a get-rich-quick scheme, but a long-term strategy for financial success. So don't be disheartened if you don't see huge results immediately. Stay the course, be patient, and let compound interest do its thing. Lastly, discipline is key. Regular saving and investing, reinvesting dividends, avoiding high-interest debt, and being patient might sound simple, yet they require a great deal of discipline. It's all too easy to deviate from the path, but remember, the rewards are well worth the effort. Remember, the secret to harnessing the power of compound interest is simple. Start early, save regularly, and let time do the heavy lifting. Each decision you make today can have a profound impact on your financial future. Make those decisions wisely.